still in the studio with me to unpack the announcements are the CEO of Financial Derivatives, Bismarck Rewane. We also have joining us Femi Oladehin, partner at Argentil Capital Partners, and Egie Akpata, chairman at Skymark Partners. I want to come to you first, Bismarck. No surprises. I think you did call a moderate hike.
Moderate hike, yeah.
And many will suggest a bit of signaling, but perhaps more significant is the review of the asymmetric corridor. And I wanted to hear your perspective on what do you think the MPC's game plan is there?
Actually, basically, it's to take away, all right, the excess liquidity
to
in the
attract
system.
Liquidity from the banks with high rates.
Absolutely, to reduce the level of money supply saturation. We also mentioned the high-powered money and the transmission effect. I think it was a very candid analysis. It was no drama about it. But he did talk about the real interest rates, real effective interest rates, which means that he has his eyes on inflation and he has his eyes also on effective interest rates. How that will play out is something that we have to wait and see. But definitely, the fact that he has that in his vision, in his horizon, means that he's going to do, or they are going to do, the right thing. I think there's no question about it.
Right.
And I noticed de-emphasizing the unorthodox monetary policy. In the past, you would hear about we've given 1 million users of anchor borrow. So I think just de-emphasizing that meant that he realized that those were negative in the sense that it put money, excess liquidity in the system and actually addressed the exchange rate. He also did say that there's going to be intervention around the comfort zone, all right? So I think that also tells me that there's a project, you know, what I would say, there's a vision about what the exchange rate should be, and there's a process for keeping the exchange rate at that level. There's also a complete focus on inflation. So if you had those two, and then you have the interest rates adjustment, which is inevitable, then we are likely to be going towards equilibrium. And he did allude to the fact that he realized the lags. A lot of people think that it's an instant reaction. No. But I think, in all fairness, we are going to see interest rates increase in the money market. We are going to see effective lending rates increase. We are going to see a de-emphasizing of the unorthodox policies, right? And I think there will be a slow build back of confidence. Very slow build back.
Right.
Nothing instantaneous.
All right. Let's go to Egie now. Egie, what did you make of the announcement, especially the adjustment of the asymmetric corridor, which effectively takes the deposit rate at the central bank at 14.75%?
Well, I think, I predicted no move. As far as I'm concerned, nothing has really changed. You have 5 people who voted to keep rates unchanged. In context, 25 basis points on 18.5. That's equivalent to like an 8 or 9 basis points move by the major European, the ECB, Bank of England, or Fed. If you're at the 5% level and you're moving 25 basis points, at the 18.5 level, 25 basis points is a rounding error. It's significant, but it's a signal. In terms of the asymmetric thing, what most people might not know is that banks have a cap on how much you can place in the central bank at the MPR plus 3 now. I think it's capped at 7.5 billion.
You mean minus 3?
Very material. Yeah, minus 3, sorry. So that 14.75, you can only place about 7.5 billion or so at that level. Now, unless the plan is to remove that cap and allow banks to place as much as they want in the central bank at that rate. Now, if that is done, automatically, it doesn't make any sense to buy any treasury bill at 6%. You just take your money to the central bank and dump it there at 14. Again, let's see what they do. But the reality is that most things that can be done now are purely administrative. There are lots of circulars that keep coming out, on how they will deal with some of these things. MPR doesn't do anything at all to market rates. It impacts bank borrowing. But I think what the message I heard underneath the hood is that there's going to be more administrative steps taken to deal with liquidity. unless, and it's not really one of these variables that they mentioned today.
All right. Let's go to Femi now. Femi, your big takeaways from the first showing of acting Governor Shonubi, it did appear very measured in everything he said. What big takeaway for me was that he acknowledged the pent-up demand and its impact, but even while not necessarily explaining a way forward in terms of how that will be addressed, he's optimistic that it will be addressed over time. What's your reaction?
So you would not even believe this. My first big takeaway is that finally we have an economist as central bank governor, because that's also a thing. You know, Bismarck alluded to the fact that all of the extraneous things that the central bank used to do, and where a lot of the focus used to be, seemed to be de-emphasized by the new central bank, and I think that's a positive, whichever way you look at it. We all knew that when it came to policy movements, the central bank had limited headroom or leeway to be able to do much. I think that there's still a mental block in terms of the limits to which certain variables can move, and I think until we get rid of that mental block, we'll continue to see this, you know, almost muted reactions to the things that are happening around us. Look, I think that the focus on inflation is an important one. I am one of the few people that believes that the inflation rates being touted by the FOS are nonsensical. And I think that in itself creates a problem from a policy point of view. It's almost impossible that M2 or M3 has moved by as much as it's moved in the last 5 years, and the kind of the highest inflation numbers we've had is 22%. It's almost nonsensical, and that in itself creates the problem that the central bank has, because if we had real inflation numbers, then the central bank would actually realize that they have sufficient room to actually make policy adjustments. Electricity rates are going to go up. We all know that that's almost an inevitable. So inflation is definitely going to trend higher than the 22% base that we have now. And that in itself is probably the biggest challenge that this central bank has. Also remember that we currently do not have a full government in operation. That would obviously change in the next month or two, at which point the federal government would now need to start implementing its own policies. And how the central bank responds to what is obviously going to be an aggressive spending by the new government becomes even another issue. I think that the problem the central bank is facing is an unusual one, and it's probably, for me, I feel a bit more confident knowing that we have, you know, an economist effectively as central bank governor, so he can focus on what he needs to do.
All right, thanks, friend. Okay, let's go back to the road ahead now. So we've had this meeting, but clearly, even from the communique, there's still there's still quite a few challenges ahead. Yes. Pent-up demand, as the acting governor mentioned. Inflation continues to be a big challenge. In your view, how do you see the central bank navigating this moving forward?
First of all, I think coordination between fiscal and monetary policy is given. Two, that it is imminent that Nigeria needs new money. To get new money, you have to come up with a structure on how to manage the existing debt you have. So that meeting with the Washington Consensus, the Paris Club and the London Club is imminent, and there are seven conditions that come with that. Thirdly, the segregation between policy autonomy and instrument independence, right? That is the key, that's the big elephant in the room. In the last dispensation, there was no policy autonomy, neither was there instrument independence. So everything was handed down. Now that you have, under the new system, I think that you're going to have no policy autonomy, but you'll have instrument independence, which means that the central bank can do whatever it likes with the instruments. But setting the target for inflation, charting the direction, will be a function of executive intervention and that happens everywhere, in the UK and all of that. So, in my judgment, you are going to see a creditor-intensive policy environment which allows
What do you mean
us.
by that?
What I mean is that you would have a lot of intervention from the IMF, the World Bank, the creditors. One, to make sure that we achieve fiscal consolidation, and two, that we are in a position to have the absorptive capacity to take new money. Because
Do you think that's inevitable to move us from where we are?
Yes, you cannot, because if you take everything that has happened and you have a GDP of $500 billion, maybe 200 trillion naira, and you're talking about palliatives of 500 million and all that, it's not going to move the needle. It's less than 0.025 of GDP. You need at least a 10% of GDP level, which means that you need nothing less than $20 billion, right, of new money and existing money to move the needle, right, and in capex and all the other things. So if you're going to do that, then you have to make yourself, how would I put it, viable. So what do I expect to happen? Financial advisors are appointed, rating agencies are engaged, discussions take place with the Washington team, then over to Paris, and then London with the London Club of Bankers and the Eurobond providers. All of this will take maybe about 9 months in all. But once you do that, and people now see the signals, you find that the currency begins to stabilize around this real equilibrium, real effective exchange rate.
Right.
That's what you will see.
Again, let's talk a bit about some of these challenges, especially with respect to investor confidence and how that can be fixed over time. That clearly is a big issue. We have seen, even with the adjustment of the exchange rate policy, we have seen very little in terms of inflows from foreign investors. And as Bismarck has alluded to, it seems foreign capital will play a role in moving Nigeria forward at some point, given the capital requirements of the economy.
Well, I mean, I think I have a very different view from that. I think one thing we've learned in Nigeria is that lending a lot of money to the federal government solves almost nothing. I mean, in the past 8 years, federal government debt has grown by at least 50 trillion. And I'm not sure anybody can point to any structural thing that has solved. Definitely not power, not security, not education, not health, not water. There's just nothing.
I hear you when you say that, but I think the issue is how do we move forward? And when I say foreign capital, I'm not necessarily suggesting government borrowing. I just feel that potentially we need capital from somewhere.
Yeah, so in terms of, again, so here's a practical reality. I mean, foreign capital looks at the rules of play in the field, and certain kind of things are things they don't want to deal with, right? So right now, take the foreign exchange market. I mean, you have this very strange spread between, NAFEX, closing I&E, and where trades are happening during the day, and where the black market is, or the parallel market is. You can't have those kind of spreads. It just suggests something is not right. You have CBN interventions at 742, when people are trading at 840. All these kind of strange looking things do not encourage foreign capital, because you basically are running an allocation type system, even though you claim you're running a market system. So if we're running a market system, let's run a proper market system and let everybody know that they will live and die by the rules of the market. Doing things halfway house probably ends up with nothing.
Right.
I think in reality, the big one is the FX market. There was nothing said today that changes the trajectory in that FX market. The only real thing that will solve that market is more CBN sales into the market, because reality is that CBN sales of 10, 20 million a week compared to before, when it was more like 200 million a week, it's not going to cut it. So if your reserves are really 33 point something billion, then bring some of those reserves out. So that's what you need the reserves for. So I think there are some practical things around supplying that FX market, running a proper market system, not printing money, living beyond and within your means, that are very important signals that have to go out from here. But again, when you have so many foreign investors that are still trapped in Nigeria and have not gotten out, I'm not sure their friends are going to be rushing in when they know their colleagues are still stuck.
Right.
So it might take a while, but I think the big signal is really around, are we running a market system in certain areas like FX, or are we not running a market system? Right now, we're kind of stuck in between.
Okay. Femi, I only have about a minute before we round this up, but maybe you can also comment on domestic capital, because it's not all about foreign capital. domestic capital is also sitting on the sidelines right now, given the policy, the lack of policy direction and so forth. And of course, even the macro situation is not very encouraging. What's your view on how we can tap more into domestic capital?
Look, I mean, Wale, I think ultimately it's about the direction that the current government wants to take the country. Look, they've had 60 days now to give us a cabinet. If you wanted to show even local investors that we're in a crisis, the first thing you would have done is you would have given us a cabinet literally 60 days ago. And I think it is the confidence that the market has in policy direction that drives people to make investment decisions. It's just as simple as that. Markets like predictability. If there's no predictability, they want to be able to buy a hedge against it. I mean, and I think that's just simple economics. Now, the truth is that signaling is extremely important. I agree with Bismarck and probably a little less with Egie on specific things that need to happen in terms of ensuring that we're able to encourage some form of reflation of the economy. And that reflation has to be FX driven. Now, you would almost imagine that probably the biggest wins is to focus on the government just trying to solve the conundrum we have in the oil and gas space. The truth is that if we had our production at 2 million barrels a day, we probably wouldn't be having this conversation, right? We're losing 1 million barrels of production every day that is bleeding out of the economy, that if we are able to get that solved, you effectively have a reflation of the foreign exchange market and you start to see some stability in there. However, I mean, I think the key here is, we don't have another MPC for a couple of months. By that time, we would have a new Minister of Finance, would have a complete finance team. Right. Those guys need to take the road. They need to go out to the world and tell people that Nigeria is open for business and also show the market that, look, Nigeria is serious about being open for business. I think that roadshow for me is the biggest thing that needs to happen in the next couple of months. Right. And then with a plan to saying that, look, probably in the next few months or in another year, we'll try to tap the capital markets again for some form of long-term funding. But honestly, this very interesting times for the country. And the current government have to realize that they don't have a lot of time. And every single day we wait without having a cabinet is a day lost for the Nigerian economy.
Well, clearly we are seeing the impact of every single day in the parallel market, especially with the exchange rate. Thank you so much, gentlemen, for your time. That's all we have time for as we cover the July meeting of the MPC in Nigeria. My guests have been Bismarck Rewane, the CEO of Financial Derivatives, Femi Oladehin, partner, Argentil Capital Partners, and Egie Akpata, chairman, Skymark Partners.